Welcome to an Introduction to Accounting, brought to you by Parkbench Tutors and narrated by David Hopcroft. This short podcast continues from the first on the financial position of an entity and discusses liabilities. How do we define a liability? A liability is the present obligation of an entity arising from past events. Settlement is expected to result in an outflow of resources, usually cash. The entity will have received goods or services, or will have borrowed money to incur the liability. Suppose the entity purchases £1,000 of raw materials on credit, with terms of payment within 30 days. The entry to the accounting system will be a debit to inventory, and the liability is recorded as a credit to trade payables. Trade payables is an account used to record current liabilities. We group liabilities into current and non-current liabilities. How do we then define a current liability? A current liability is expected to be settled within the entity's normal operating cycle. For most liabilities, they are expected to be settled within terms agreed. At the end of the financial year, the current liabilities are those that will be expected to be settled within the 12 months following the year end. Typical liabilities fall into the following groups. Trade payables are the invoices received but as yet remaining unpaid. Bank overdrafts are sums of money borrowed from the bank over a short term. Accrued expenses are those liabilities that result from incurring the expense but having not yet received an invoice. Tax liabilities are where tax is owed and is calculated but the payment is yet to be made. Any other current liability can be classed as other payables. Non-current liabilities include any long-term payables and bank borrowings, debentures and provisions. Debentures are a form of stock. They are loan stock, where an entity raises money by issuing loan stock to be repaid with a set interest rate by or on a particular date. Those who hold loan stock may sell their holding on to other individuals or institutions. Holding loan stock does not give you the rights that a holder of ordinary stock has. How can we be certain we are recording all liabilities correctly? Accounting uses the accruals or matching concept. The matching principle states that we record transactions when they occur and not when any cash is received or paid. It is possible that at the end of an accounting period there will be a number of goods or services that an entity has received or used, yet no invoices have been received. These should be recorded in the accounts as accruals. Typically they include utilities, interest and taxes. There are some liabilities that may not be as clear-cut. It may be that the amount is not identifiable with complete accuracy, or the timing is not known precisely. These may still need to be in the accounts. They are referred to as making provision. Falling into this category are such things as warranties. A proportion of the goods sold with a warranty may turn out to be faulty. It is not possible to determine an exact amount at the time they're sold. An entity may, of course, choose to pass this liability to a separate entity. What are the criteria that we use to determine if something is a liability? Remember that we said that there must be evidence to show that an outflow of cash or other resources will occur. We should also be able to make a reliable measurement of amount. Now, can something still be a liability if it fails to meet these criteria? It may not be possible to include them in the accounts, but there can be notes to the accounts to include contingent liabilities. This follows the prudent nature of financial reporting. A lawsuit may be in progress where the outcome has not yet been determined, but it is possible that the payment may have to be made. There may also be a liability for defective products that have been sold. After deducting all the liabilities from all the assets, we are left with a figure that should be equal to equity. This figure will be made up of items such as share capital, retained earnings, and reserves. Note that the term net assets is used for the total assets less the total liabilities. Let us recap on two ideas to check our understanding. First, depreciation. I bought a computer system in January for £3,000 and expect it to last 4 years with a residual value of £200. Using straight line depreciation, how much accumulated depreciation should I record at the end of the year? Remember that by the straight line method, depreciation is the cost less the residual value divided by the useful lifetime in years. So the depreciation will be 3,000 less 200 divided by 4, which comes to 700. We will depreciate the item at a rate of £700 a year over 4 years. And our understanding of accruals. On December the 31st, I have not received invoices from the telephone company, but I can see from the online account lookup usage of £40. What should I do? We record the telephone expense of £40 as a debit to that account and the current liability of £40 as a credit to that account. This ends our second podcast on measuring and reporting financial position, brought to you by Parkbench Tutors. Thank you for watching and for listening. We wish you success in your studies. For more information about Parkbench Tutors, please visit parkbenchtutors.com.